Good morning and good afternoon. My name is Don Wilkinson, and on behalf of my partners and colleagues at Deloitte, and in association with the Institute of Corporate Directors, and of course, our good friends at BCN TV, welcome all to the Director Series. The focus today is on audit committees, and that's going to be twofold. One, obviously fast approaching, are those year-end audit committees, so we're going to be talking about some issues that you should be thinking about for those upcoming meetings. The second aspect would be a little longer term, so things you should put on your agenda for 2015 and beyond. Now, we're tucked away in a warm studio here in Toronto, broadcasting to you live to 16 cities across the country. Now, I actually just heard, I need to correct that, it's only 15 cities. Apparently, a big snowstorm in Newfoundland, so unfortunately we lost our friends from Newfoundland for today. The turnout for this session has been fabulous. We have well over 1,000 registered, so obviously a lot of interest in the session. And I will take this opportunity to wish you all a very happy New Year. Trust you brought the new year in style, and things are looking very promising and encouraging for 2015. Certainly, if you're hockey fans, our good young Canadians beat their arch rivals, the Russians, brought home the gold. A bit hard on the heart, but a fabulous outcome. So very promising start on that front. I will say, however, there are a few clouds on the horizon. Some of them are snow clouds. This is winter. This is Canada. But other of those clouds relate to some of the issues in the global economy. So one only needs to think about what's happening over in Europe with risk of deflation. Of course, Japan's been fighting it for decades, and the big growth engine post-credit crisis with China, but now that is slowing down. For us here in Canada, big story is oil. Oversupply, lowering demand, and of course the Saudis aren't turning off the taps. So that has very significant implications for us here in Canada, and certainly for the companies operating in that industry. I will say, amidst the clouds, there is a bit of sunshine coming through. There is the big juggernaut just south of us. I won't say it's firing on all cylinders, but some of the cylinders, and sounding some encouraging growth signs south of the border. So for those of you that export into that market, and you'll also benefit from the low loonie, obviously some good news. These are obviously some important issues that your boards and audit committees are going to need to be grappling and thinking about the risks and the opportunities as you go through your upcoming meetings. And we'll be talking a bit more about those as we go along in our session. Let's take a look at our agenda for today. And just like I presume your agendas for this year-end audit committee meeting, they're jam-packed. Our agenda today is jam-packed with lots of good information as you work through your year-end audit committee meetings. The first topic we'll be touching on is audit quality. Obviously, a lot of discussion around audit quality subsequent to the credit crisis, and I think very interesting in terms of some of the recent developments in 2014. Here in Canada, there's going to be a lot more transparency, so you'll be aware of the inspection results for your particular company if it is selected for review. So more transparency under the new protocol, so we'll be hearing a bit more about that. Internationally, I think there's some very interesting developments out there. And as we know, Canada is not an island. Things do wash across our shores, so my guess is there's some things that you need to be thinking about in the longer term in terms of what could impact you and your organization. Of course, it is the year end, and the focus is on financial reporting, getting those financial statements right and other disclosure documents. And therefore, we thought it'd be good to hear from the regulator what's on their radar screen. What are they going to be looking for? So you can reflect on that as you work through that year-end audit committee meeting. As part of the panel discussion after that, we're going to broaden out the discussion. We're going to touch on this issue of the quality of financial reporting, and I'd even broaden that out further to say corporate reporting. For those of you that were at our last Director Series, I talked about a publication we put out, Is More Less? And we've talked to a number of stakeholders in financial reporting areas, And there's a concern that the reports are getting longer. It's getting harder to find key information. There's a lot of boilerplate, a lot of time spent looking backwards as opposed to forwards. So we're going to spend a little time with committee talking about, and the panel talking about, what are the things that might be done, and hopefully get you engaged in that discussion. I talked about clouds. That often brings to mind risks. So we're going to spend some time on what are some of the big risks that are out there that will impact your business, but also need to translate into some things you think about at your audit committee, and talk about what audit committees should be doing in that area. So spending some time around the topic of risk. And then finally, a subject that is really sort of the nuts and bolts, that is internal control and certification. And it's been around for a while, but the issue is that on just autopilot? Are you getting everything out of that? Because it really is one of your best friends in terms of protecting the corporation and directors. So we're going to spend some time talking about that. Now, as always, there's no such thing as a free breakfast or lunch, depending on your time zone. We are going to put you to work. There's going to be 2 questions that we put out to you and get you engaged in your local settings around some of the issues that we'll be discussing this morning. Also, we will have some time at the end of the session for questions and answers. What I would say is do not wait to the end to get your question in. To make sure it gets in front of us and answered, fill out the cards that are at each of your tables, get them to the administrator. They will in turn will beam them to us here in Toronto, and we'll do our absolute best to spend time and respond to those at the end of the session. Now, joining me in the studio today are a number of individuals, very experienced, very talented. I know my short introductions won't do them justice, so I would refer you to the handout package where you've got a fuller CV. But on my left is Brian Hunt. Brian is the CEO of CPAB, which stands for the Canadian Public Accountability Board, which oversees the auditors in terms of the work they do for public companies here in Canada. And Brian, I think you became the CEO in January 2009. A lot of changes and strong leadership under Brian's direction. Clearly the topic we're going to be talking about today, a big push around audit, upping the game on audit quality. Also programs to reach out and talk to audit committees to help them in this process. He's also very much tied into the international group of audit regulators and chairs their policy working group. Now, I think there is a history before CPAB, Brian, so I understand CPA Ontario, where you were the president of the Canadian Automobile Association, and prior to that, the president of a couple companies in the private sector. So a lot of experience. Brian, we had you here somewhat last year in a clip. We're delighted to have you here this year in person and to get your comments. So welcome to the Director Series.
Thank you very much, Don.
Next to Brian is Patricia Kierdeau-Grew. And Patricia is a senior executive with the National Bank. She's been there since 1991, I believe. She currently is a strategic advisor to the President and Chief Executive Officer of the bank. Also, prior to that, she was a Chief Financial Officer and EVP responsible for finance, treasury, and risk, which we're going to be talking about. So a lot of executive experience. No stranger to the boardroom. She sits on a number of boards. She's on the board of Cogeco Cable, Uniselect, where she sits on the Audit Committee, and also on the Human Resource and Compensation Committee, and in fact chairs one of those. Additionally, she sits on the board of the CASE, which is a very major institutional investor, and sits on the Risk Committee. She's been recognized as one of Canada's most powerful women and has been in the Hall of Fame since 2007. So with lots of experience and qualifications, Patricia, we're looking forward to your comments today. Welcome.
Thank you, Bill.
Now, next to Patricia is a face that I think will be quite familiar. Cameron, we've had you on a couple of times on the Director Series. Cameron, of course, is the Chief Accountant at the Ontario Securities Commission. Obviously, a very critical role in terms of looking at those year-end financial reporting disclosures. and issues, and be here to provide some insights around that. Lived through the IFRS transition, so it'll be interesting reflections on that activity. Was also the Commission's rep in terms of the Audit Quality Initiative. Now, for those of you on the West Coast, there's a lot of Western blood in Cameron, so graduate of UBC and was with the BC Securities Commission. So Cameron, welcome back, and we're looking forward to your comments.
Thanks, Don. Thanks for having me.
Now, last but certainly not least is a face I know many of you will recognize. That is Jim Goodfellow. Jim was formerly a vice chair of Deloitte. In that capacity, he looked after a number of major corporate entities, and always a true passion for corporate governance. I must say he was the founder and moderator for the Director Series. So if Jim jumps in and takes over moderation today, you'll know he comes by it honestly. Certainly on the governance front, a lot of speaking, a lot of books written. With Maureen Sabia, Spotlight or Integrity in the Spotlight, which is a great read for audit committees. And recently he's done something on internal control and certification, which we'll be talking about today. Now, when he left Deloitte, it wasn't retirement. He's been doing a number of things, sits on a number of boards, large cap in the retail sector, small cap company, and also with the government, where he sat with the Department of Foreign Affairs and International Trade. So a lot of governance experience that Jim brings to the table. So Jim, welcome back to the Director Series, and we're looking forward to your comments.
Great to be back, Don.
So let's get started. It is a full agenda, and the first thing up is audit quality. Now, Brian, not long ago you held a very successful symposium that you hosted. There were a number of international guests talking about some of those developments, and a lot of discussion about what's happening in the Canadian marketplace. So I'll turn it over to you to talk about some of the implications for audit committee members.
Well, Don, thanks very much. I appreciate being here this morning and the opportunity to speak to 1,000-plus directors on some of the issues around audit committees and the focus that we have this morning. What I want to do is cover a little bit in terms of the relationship that CPAB has with audit committees, some external auditors, relationship with audit committees, and the management as well, management of the organizations and their relationship, and the chart that you're looking at. One of the things at CPAB we started in this past year in 2014, we'll continue it into 2015, was to outreach to audit committees and really asking the question of how can we enhance or help them enhance audit quality and make them hopefully more effective in what they're doing. And I think we've had a number of initiatives around that. One of the keys we think to this is making sure that, and Don mentioned this in our transparency efforts, we've done a public report for a number of years. This year, in 2014, in March, we started sharing with audit committees significant findings that CPAB has. These are findings that, in our view, the auditors have not done enough audit work to support the opinion. So they're rather significant, but we have developed a protocol with the firms where the firms would share this information, and we think that's a huge step forward in the whole area of transparency. But one of the things that we, in talking to audit committees, as we've reached out, we're encouraging, and one of the things we're trying to do is by greater transparency and hopefully utilization of our public report, which has typically come out in March. We put the Big Four report out in November, and that was really at the request of some of the audit committees in order to get an early update in terms of some of our significant findings and also assist audit committees as they approach their own year ends. Most of the year ends in Canada are around December 31st. So one of the things that we've been trying to work with audit committees on is to ensure that there's a robust discussion between the external auditors, management, and the audit committee. And we think if there is a robust discussion, we will improve audit quality. And one of the things we've been chatting about is talking to audit committees and getting them to reflect a little bit in terms of, in their meetings, are they very much in a compliance mode, or are they moving towards governance or in a governance mode? And what I mean by that is the difference in terms of compliance is really going through and saying, yes, the audit's been completed. Yes, we got a clean opinion. Meeting is concluded. We had some discussion, but not a lot. When you start to move towards what we would refer to as a governance mode, you're really addressing some of the key audit risks. And we think this is so important. As you plan your audit, you identify key risks. Have those risks been mitigated? Have you discussed with management and the auditors in a robust fashion in terms of how you came at, how estimates were developed, how valuations were developed? Has there been disagreements between management and the auditors in how the process of developing those types of things or the tough issues? Even though they may have been resolved before they got to the audit committee, has the audit committee really delved in and had some good discussion around that? So one of our focuses is what can we do at CPAB to encourage a more robust discussion between the auditors, the audit committees, and management. We think that's key to, in the long term, enhancing audit quality. I also wanted to touch this morning on, and Don has talked about our symposium. We held a symposium in December last year. A lot of international developments. Canada is not an island, as Don has said. There are a number of developments that are occurring in Europe and in the United States that will impact us. For example, in Europe, mandatory firm rotation has been put in place by the European Union. It's over a 20-year period. And I won't get into all the details around that, but I think that's something that people should be looking at. And I think one of the key to that mandatory firm rotation is you need to think about that in terms of where somebody might say, well, it's 20 years, I don't have to worry about it for a while, or I don't really have an operating subsidiary in Europe. Well, there's two things I would raise with the group. Number one, if you watch in terms of the 20 years, the Netherlands and the European Union has indicated to the 28 member states that they should feel free if they wish to raise the standard, and that would mean implementing a different standard than the 20-year mandatory firm rotation. They should feel free to go ahead and do that. And a number have. The Netherlands, for example, moved to an 8-year mandatory firm rotation. I understand they're going to change that to a 10-year mandatory firm rotation. So in Europe, you may have very different requirements in different countries. So you need to be aware of that. You also need to be aware that there's a term used in Europe about public interest entity. So you don't really need to be raising capital in Europe. You don't need to have a subsidiary there. But if you have a significant business operation in those jurisdictions, you may be swept up in some of these rules. So that's something that I would encourage everyone to have a real good look at. We also are aware that there's going to be an expanded audit report. IAASB has approved that, so sometime in 2016, 2017, we will see an expanded audit report, which will include, and I think the key to this is key audit matters. The U.S. is also looking at this, and the U.S. tells us that they will have something out in a timely fashion in 2015, and they will be right there with the Europeans in terms of implementation. So in those expanded reports, you're going to have a report of pass-fail go from 1 page to probably 5, 6, 7 pages of what is being referred to as key audit matters. These are matters that are key to the audit, what has been important, what are some of the more challenging audit areas. Does this make this more relevant? I think that's a real challenge, and I think that's where some of this has come from in the European community. One of our concerns in all of this is it's implemented that it does not become boilerplate, and I think that's something that we all need to really focus on, because if it becomes boilerplate, we'll go from a pass-fail 1-page report to a pass-fail boilerplate on critical or key audit matters to 5 or 7 pages, and I don't think we'll get what we were looking for. I also want to just touch on one other thing that's coming up, and a number of people ask me as we go to audit committees, how do you measure audit quality? And that is a challenge. A number of folks have looked at that. But I think we're developing tools internationally, and I think the U.S. is taking the lead on this, is tools which will help audit committees determine whether they've had a quality audit or not. And one of those areas is key audit or audit quality indicators. And hopefully in the discussion, Don, we'll get into some of this as to what those are. But I think those are areas that, and they're trying to get it down to probably 15 or 20 key audit indicators. So if you can do that and you can put some context around it, I think it'll be a tool for audit committees to really work with their auditors in evaluating audit quality. Let me move maybe to, I'll say, the domestic front in terms of coming back to Canada. And while what I've just spoke about in international will definitely impact Canada, I think there's some things that we've been doing in Canada that I'd like to raise with you folks this morning. I have mentioned the protocol. CPAB wants to be more transparent. We want to see that our public report is more utilized by audit committees, but also importantly is that our key audit findings, these are significant risks, are shared with audit committees. And again, we're trying to create that robust discussion between management, the auditors, and the committee, and give you some additional tools to evaluate audit quality, but also to highlight areas where we would have some concerns. I want to touch on two things. One is we spend a lot of time looking at auditing in foreign jurisdictions. And I think that's one that's a key challenge. If you're doing business in a foreign jurisdiction, I would encourage you, as you've gone into that business, I'm sure you've looked at the different cultures, the different business practices, the different legal structures. That is really no different when you're doing an audit. And I would encourage you all to have a real hard look at this in terms of what is the culture in that jurisdiction, what are the business practices in the jurisdiction, and what are the legal structures in particular. And it's not that you can't audit in those jurisdictions, but I think you need to really ask your auditors, how have they adjusted their audit procedures to reflect a different culture or a different business practice? In some jurisdictions, we've learned over the last number of years that you can't rely on bank confirmations that we rely here on in Canada. So you've got to still establish that there's either money in the bank or there isn't. So what procedures do you use to do that? So I would encourage you to think through that carefully and discuss that with your auditors. I also want to touch on some trends in the audit fees. And that's an area that we do have some concerns in relation to. And this isn't, from our perspective, we don't want to interfere in a competitive marketplace. We understand that there is a good back and forth with the audit committees, the auditors, management, etc., on what the fee should be. But we do get very concerned when we hear about fees dropping by 40 or 50%. That to us is unrealistic. There are certain efficiencies you can drive, but for a fee to drop by 50%, that just doesn't make sense. And what you've really got to think about is from an audit committee perspective, is that audit firm going to put the resources necessary to do an effective audit? And I think those are some of the issues. But it's not just the current audit that's coming up. It's that audit 5 or 6 years from now. And one of the things that we're concerned about at CPAB is that we have a viable audit market down the road. And if you see fees continuing to decline or if margins continue to be squeezed, because it's not just the decline, it's where the fees don't rise. So the firms all have to pay their salaries in terms of staff more, the costs of office space is increasing, so the margins are being squeezed as well. So when the firms, or if the firms stop investing in their people or in regard to training, in regard to experience globally, internationally, doing a number of things like that, that's a real challenge. So I would encourage you all to really think about this in terms of where audit fees are headed. Is it a reasonable fee for the services being provided? So those are just some of the things that I wanted to touch on this morning. Don?
Brian, thank you. I know a very full agenda that you're working with because I was in attendance at the symposium. One of the things I find very interesting is this whole issue of understanding what do we mean by audit quality, and it's a difficult concept. How do you explain it? What should audit committees be looking for? Obviously, you refer to audit quality indicators, which I think will help audit committees get a better handle on it. But maybe a bit more about what is audit quality and the indicators to help audit committees understand that.
Well, I think from an audit committee point of view, you develop an audit plan. You discuss that with the auditors. You discuss that with management. That plan identifies your key audit risks, your key business risks. Are they being mitigated? In terms of that robust discussion that I think needs to take place between the audit committee, management, and the auditors, have those key risks been mitigated? And if they have, I would say to you probably 99% of the time you've got a quality audit. But in order to maybe have that discussion in an effective manner, there are certain key audit quality indicators that may be of assistance. And let me just give you one example. I mean, one of the ones that they're looking at is the amount of time that the engagement partner or partners spends on a particular engagement. Is that 25% of their time? Is it 30% of their time? That may in itself not be the sole indicator, but it's really trying to put context around that. So when they spent 30% of their time on the particular audit or whatever it happens to be, was that putting out fires? Was that value added? What was actually being done during that period? Is that the norm? Is that something that if you compare an audit of a similar size and another engagement partner was spending 60% of their time, is that something that the audit committee should be concerned about? But those are all discussions that I think will lead to enhanced audit quality by asking the auditor to explain why maybe 60% of the partner's time was spent on this engagement versus 30% or 25%. But it really is key to put the context around that to make sure that you fully understand as to what was being discussed during that period.
Now, Jim and Patricia, you serve on audit committees. Your experiences in terms of audit quality. What is it you're looking for in your committees and meetings in terms of the audit quality, and maybe even how do you differentiate? There's audit quality and then audit service. Are those two separate things you look at? Different, but maybe Jim, I'll start with you, and Patricia, your thoughts on it too.
I think it's a big struggle for audit committees, and I think that. The issue of what is audit quality is a challenge, and as Brian alluded, we can only get at it indirectly because you don't want the audit committee getting audit files and plowing into that level. That's what CPAB's all for. That's what they're supposed to do, kind of thing. But I think the audit committee can get a good reading on several things. One is, what's the quality of the audit plan? And what does the audit plan really address and line up their risks identified in the audit plan? Does that line up with the audit committee's assessment of risk? And is there a connection there, kind of thing? What's the quality of the reporting? What are the findings? What's the information that's coming back? What's the level of communication between the auditor and the audit committee? Are we dealing with minutia, or are the auditors surfacing substantive issues and reports in their interaction with the audit committee? So, Don, I think that the audit committee has to look at those levels of things because you don't want the audit committee trying to dive down, and that's not their job, and that would be a waste of time. That's Brian's role, is to deal with that. But that would be my quick assessment.
Patricia, you're.
I would say, I would tend to agree with what Jim just said. I guess the other thing is, from 1 year to the other, are we touching base on the same issues? Are we taking notice of what's happening in the outside world, bringing this back in context with what's touching the company? And are the auditors really in tune with that, or they just have a cookie-cutter program touching again on the same aspect? They're comfortable with that, management is comfortable with that, but then you have an issue of trying to break out of that mold and trying to push them to ask themselves, other types of questions that could impact the company.
Yeah, I think that's a critical part is understanding, do they really understand the industry, the outside world, bringing that perspective? Do they understand the commercial challenges, the incentives, those sort of things? And that would come out through discussion at audit committees. Just thinking about the annual and 5-year assessments, and any advice? A number of companies out there have embarked on that. A number have not. Any advice you would give to audit committees to how do they embark on this? And I guess the subpart I'd like to also for if you're a smaller company, how do you deal with this? But let's deal with the first one.
Well, I think there's a number of tools that CPA Canada, ourselves, ICD have developed. That's a good starting point. Get access to those tools. Those tools try and go through in a step-by-step fashion of how you would approach this. You also need to access CPAP's public report, which under the protocol is being provided to all audit committees by the auditors. I would encourage people to look at those. The findings that we have there, to have the dialogue with the auditors in terms of things like professional skepticism is something that we are very concerned about, the lack of that in a number of audits. You could ask your auditor to demonstrate or discuss around the risks that you've identified, as Jim's talked about in the audit plan. How did you demonstrate professional skepticism? What did you challenge in terms of management? And this isn't a challenge in terms of directly challenging an assumption or assertion, but really, did you come at it in a different fashion and come up with the same conclusion within a reasonable period or a reasonable spectrum of reasonableness? So I think you can do a number of things. We have been working with a number of firms that have embarked on this. There is a fair amount of work to do. I think the tools that we provided are scalable for a smaller entity. So I think you need to think about that. For a large entity, after the work is done, we're estimating that it's probably an hour of meeting time to go through an annual review. It's probably 2 hours of meeting time for a comprehensive review every 5 years. There is a lot of work that leads up to that. We appreciate that. But I think it is scalable. And, if you scale that down to a $50 million market cap organization, maybe that's an hour of meeting time in terms of the 5-year comprehensive review. So I don't think we're asking, we do recognize that audit committee agendas are jam-packed. They don't have a lot of time, but I think this is something that's really worthwhile doing.
Patricia, your thoughts on this?
I guess from the scalability, I would say, if you're looking at smaller firms, is looking at the whole program and the tools, and I guess deciding with the management, with the auditors, with the board in terms of touching on certain topics of first year, second year, third year, and there's no expectation that everything can be done at the same time, and trying to identify the key elements and have a wholesome program that's feasible for probably the next 2-3 years. That would be, I guess, my takeaway in terms of how applicable it is for medium type of enterprises that don't want to entertain the 1 or 2 hours extra. It's always a burden for a lot. It has to be done, but there's a lot of skepticism when you try and implement it. So if you have something that's a little more expandable, reasonable, and acceptable, I think it makes for a worthwhile exercise.
It is, and we've been through at our firm annual and a 5-year. And by the way, there is considerable work if you do a good 5 years. So it does take time and effort. The interesting thing is how to scale it. And Jim, you dealt with smaller cap. Like how do you make it real in a small cap world?
Well, I think the key here is that you've got to embrace both management, the auditors, and the audit committee, as you got to embrace the concept of continual improvement. It's got to be a continual improvement exercise. This is not a pass-fail thing. It's a continual improvement. Okay, so if you embrace that, then annually you should be taking time. And then small cap, you don't need to have all of the structure. A big cap company, large cap company, well, you've got divisions, subsidiaries, foreign operations. Becomes a much more complex exercise. Small cap company, it's a more simple exercise because the operations are more simple. But it's the question of how can we get better? How can the auditors get better? How can management get better? Are we embracing healthy professional skepticism? And how can the audit add more value? We're spending a lot of money on auditing. How can the audit add more value? The shareholders are the beneficiaries of the audit. They're the ones who get the money. But the customer is the audit committee. So how does that audit resource, how can you enhance the value? And how can you get better? What are the things that management can do? How can you be more efficient? How can you be more productive? These are all good questions that if you embrace the concept of continual improvement, then you should be doing this every year. And then periodically, you should do the step back. And I would suggest, Don, the good time to do that periodic step back is when you have partner rotation. Because that's a good time. You have a new person coming in, good time to do the assessment, and what are then the goals for going forward. And that way, I think we can continually to enhance both the productivity, the efficiency of the audit, but also to enhance its value.
And it's interesting around that point. I like the continuous improvement, Jim, absolutely spot on, and the timing around partner rotation, because I've seen that's when typically companies will actually do the 5-year review, the full review, thinking through it, because there's a critical decision point what you want to do with the audit relationship. I'm going to just quickly change gears, and I really just want a soundbite on this, but this new audit report that's coming out, and now they've done it in the UK. You talk about materiality, you talk about the scope of the audit and the audit of the critical areas. The report ranges from, the short end, which is probably the boilerplate, 2 pages to like 7. So there's going to be a lot more disclosure, risks of boilerplate. What is this a positive or are there some challenges in this? And maybe Jim, I'll start with you, and then Patricia, and then Brian, I'll let you just some quick reactions to where this is going, because it's gaining momentum.
Well, it's gaining momentum, and it's coming, because the International Auditing Standards Board, we were told at the symposium, has approved the standard. So get ready, it is coming to Canada. The question is, when does it come? We had a great presentation at the symposium from the UK, who early adopted this. And I must admit, Don, I came to the symposium. Sheila and I were the co-chairs for the Sheila Fraser, and we came sort of somewhat skeptical, and when we heard what the UK experience, changed our mind. And so I think we need to look at this. It's going to change the dynamic, though. When you publicly put in the auditor's report the highlights of the key audit risk areas, that'll be information that'll be beneficial to the investor, kind of thing. But that's going to change the dynamic between the auditors, management, and the audit committee. So everybody's going to have to be on side. It'll be new experience, but I think it's going to be worthwhile.
If I could just add something back to that point, Jim, investors have been asking for more information about the audit over the course of the past 10 years. We know that. We've had interaction with investors on that point. I think this is a positive trend. I think the question in my mind is, what type of entities should produce this information for what type of investors? Is this something for all types of companies? The larger ones, the more sophisticated investors, I think will benefit, but there's a lot of small cap companies out there, and will the investors really need to have a lot of this information? It's a question in my mind. I'm not sure.
Yeah, I think there'll be a lot of discussion and debate. I actually saw something from the UK director talking about it, and they were talking about the simplification process and clutter. And so they talked about it in terms of clutter, potentially. So there's a lot of trade-offs in terms of cost benefits. But as Jim points out, this is coming, so be ready and be thinking about the implications in terms of the change dynamics in the boardroom as well. Let's shift gears because it is time to get those filings done with the regulator. So Cameron, what is it you're looking for this year?
Well, thanks, Don. I thought I would talk a little bit about some of the areas that we've been focusing on in financial reporting over the past while. Before I do that, I just want to mention that the views I'm about to express are my own and not the views of the Ontario Securities Commission or its staff. What we like to do when we look at financial reporting is think about what new standards are in the capital markets and have a look at those. IFRS 10 is the new consolidation standard that was implemented in 2013 in our capital markets. And there's some new concepts in that standard, concepts about control that have changed since the old standard, a lot more disclosures as well. We looked at a bunch of issuers in this area, and the majority of issuers that we looked at, there wasn't a lot of impact going from the old standard to the new standard. I probably would have expected more impact on the de facto control situation where there's less than 50% of the voting rights, but in fact the entity does actually control, and the new standard has more guidance on that than ever before. So I thought we would have seen a bit more of those types of consolidations. To me, the big observation on this standard is on disclosure and providing good information as to why a parent does control a subsidiary. That's really what's important. I've got a couple of examples. The first one is an example of some, I would call, boilerplate disclosure. It's a company indicates that they control the entity when they have power over the entity, and power exists when they have rights to direct the relevant activities, and it can be obtained through voting rights or other means. And as such, management's determined that it has control. So not much insight there. This is really just the definition out of the standard. It doesn't really tell you much behind the thinking. Whereas the next disclosure is a bit more tailored. Talks about the company owning 48% of the voting rights, so one of those de facto control situations I was talking about. The remaining 52% are widely held, and no one has more than 1%. Previously, the company did not think it met the control criteria under the old standard, but under the new one, they do believe they have the outright power to govern the policies, and so therefore they are consolidating because they believe they have the unilateral right to direct all activities. So again, just more information behind the thinking as to how management assessed that the company controlled a subsidiary. So greater information on the judgments, more insight, not just information. And I think if you flip this last example around, if the company held 48% and didn't consolidate, well, there's some judgment and some thinking as to why the entity made that determination, and that would be good disclosure for an investor to understand why that's the case. IFRS 13 is the new accounting standard on fair value. That's effective for 2014 periods. And as we know, the concept of fair value is scattered throughout IFRS, so this standard touches upon many areas. And we are looking at the application of that standard in our capital markets and how companies are doing in that area. For example, how have entities been applying various valuation techniques? How have they been applying the fair value hierarchy, which is in IFRS 13? And there's certainly an increased level of disclosure, and that's important because there's a lot of judgments and estimates that go into fair value, and having disclosures about those judgments, in particular when you have unobservable inputs, for example, understanding how those fair values are arrived at are important for investors to understand, not just the number, but the inputs and why. There's a lot of activity in the REIT sector, so that's an area that certainly IFRS 13 comes into play, and that's a hot segment that we've been doing some looking at. The next topic I wanted to touch upon was the CSA staff notice that produces the results, that reports the results of all the continuous disclosure reviews across the country. That's CSA staff notice 51-341. It discusses common deficiencies in financial statements, MD&A, provides some helpful guidance, helpful suggestions, and some examples. I'd urge you to have a look at that notice. There's a good example on revenue recognition, for example, the revenue recognition policy, and it talks about a generic revenue recognition policy and the fact that that could trigger a question from the regulator if it's not tailored specifically to your situation, so that an investor can understand how revenue is being recognized. Revenue is obviously very important. Impairment of assets is also discussed in that notice. Often there's not enough information about what were the events and circumstances that led up to impairment. So again, more insights is what I think is needed in terms of trying to understand some of these financial statement measurements. The notice also talks about MD&A deficiencies, for example, forward-looking information. For example, if there's sales growth estimates that are included in the MD&A, why are they projected the way they are? Are there new products coming on stream? Are there new customers? Again, more insight as to why those numbers are there and why those are arrived at by the entity. So I'd encourage you to have a look at that notice. We've also got some new proposals for venture issuers that will be hopefully finalized during the course of 2015. So they're not effective now, but you can look out for those coming on stream soon. And these new venture issuer proposals are designed to streamline the requirements for smaller public companies and make sure that the regulatory burden is appropriate for them, and also to focus on disclosures that's appropriate for investors that are investing in these types of smaller companies. One example is the quarterly highlights report, and that's something that will be produced to allow the venture issuer to focus on the operations and liquidity, and that would be in place of the full-blown MD&A requirements that are currently in place. So a lot of interesting concepts for smaller companies that you can look forward to, and I would encourage you to be on the lookout for those being issued and final in the next year. Lastly, I just wanted to mention some new requirements that are in place now for disclosure of the number of women on the board of directors and in executive positions. Also, disclosures are required for policies relating to representation of women on boards and in executive positions, as well as any targets that are in place for, again, representation of women on boards and in executive positions. There's other requirements, but those are three that I thought I would highlight for you, and I would encourage you to look at those closely as you prepare your filings for this year. These disclosures are designed to help investors, well, for transparency purposes, that will allow investors to make an investment decision on these important topics or voting decisions. So it will help them in that regard to understand these features. With that, Don, I thought I would turn it back to you.
So as I mentioned at the outset, one of the things we wanted to explore with our panel is this whole issue of corporate reporting. We previously talked about is more or less. And, as I was listening, Cameron, and I was thinking about IFRS. Of course, there was a lot more disclosures coming on board with IFRS. Your example, shows that more information needs to be required to meet investor needs. But at the same time, you get feedback from stakeholders in terms of investors, directors and so forth, saying these reports are getting so voluminous and there's so much boilerplate, which you were arguing against, that we really need to get something fixed. And the question is there enough motivation? Is the system really broken? Mm-hmm. Is there a motivation to say, yeah, we do need to clean up the financial statements. We need to take a look at the MD&A. It's a very powerful document if it's used properly. But is there a sense around this group that something needs to be fixed on that front? Patricia, and Cameron, I'll get to.
Well, there is a sense that, over time the documents have become more and more thick in terms of information that it's just thrown, and we're trying to put the whole kitchen sink in terms of information there. We're doing this, the management, the board is doing this or accepting this in terms of protecting themselves and not necessarily having a true discussion in terms of trying to define the fine line in terms of what is acceptable to be born or presented to the public versus what is more for information purposes. So that's one thing, but this is a trend that went probably overboard. Now we probably have to try and diminish that. But then you have the other swing in the market where you have these shareholder activists that are pinpointing and taking actions on information that was probably not properly divulged. So the board is really and the management and the auditors, we're all in the same, obviously, group trying to define, where's the right line and where is the right position to park ourselves going forward.
Cameron.
Don, my world is financial statements, obviously, and I can talk a little bit about that. I think there's two things that we need to think about. There's a cultural aspect to this, and there's also standard setting that is in play here. And I think both of those things are moving in the right direction. I think culturally we have to think about what's the right mentality in producing financial statements. And the mentality I think about the financial statements is that they should be looked at as a communications document and not a compliance exercise. If we can get to that state of culture, I think we're going to make progress. On the standard setting side of things, a lot of progress has been done, and we already have tools in our arsenal on this topic. It's called materiality. And the actual standards, IFRS, does say that you do not need to include information that's not material. The standards have recently been amended to actually go further and say that you should not be including immaterial information that would obscure material information. So I think this is a broad issue. It's not just one party responsible. It's not just management. It's not just the audit committee. It's securities regulators. It's standard setters. It's audit oversight body. It's the auditors, to think about what really is important information for investors to have. And that, if we all embrace that concept, it would trickle down to management making those, being willing to make those determinations of materiality, having the courage to make those determinations of materiality, not including things that are just obscure. There may be a requirement there, but if it's not material, why include it? And then the audit committee being on board with management to embrace the fact that they're willing to take on that challenge of omitting information that's just not material.
Well, there's no doubt that is sea change, cultural change around as a key thing, and then the courage to push that forward. But Jim, you sit on audit committees. Is there momentum? Is there a belief that, gee, we need to change, things need to get better?
Yeah, and what I'd like to do, Don, is pose a question back to you and the panel. So let me give you a quote. Ray Groves was a former chairman of Ernst & Young in the United States, I think he was chairman of the AICPA, very, very distinguished man in the profession. And he expressed a concern that the quantity of financial disclosures has become so excessive that it diminished the overall value of the disclosures. Okay? The question is, what year did he say that? And I'll spare you the agony. The answer was 1994. So 20 years later, we're still talking about the issue. And I really echo what Cameron just said. We're all in this. This is not something that any single firm or regulator we all have to work on this issue. And technology probably provides some opportunities. Cameron suggested, there's things that we can do now. But I worry about two things. One is a lot of our highly technical disclosure, we're playing defense, not offense, which ties to your communication strategy. So we have a lot of highly technical disclosures that I think do more to confound the reader than inform the reader, kind of thing. And the second is the key messages get lost in the volume. It's sort of like key things that are hidden in plain sight. And the analysts figured them out. They zero in on them, kind of thing. But I think there's a lot that we can do, and it costs a lot of money to produce all of this. And so I'm encouraged with what Cameron said, that Cameron's position, and some of the developments that are going on, both the United States, where the SEC looks like the new chairman has got an initiative in this area. But we all got to work on it together.
And the standard setter acknowledges this too. The ISB does have a project going on in this area. The one example that came to mind as we were talking about this morning was a presentation that I heard from the controller of Intel talking about this topic. And she was saying that the pension disclosure in their financial statements is 7 pages long, and the R&D, inventory, and capital assets information was a half a page. Yet that's their whole business. So do we have the right balance of disclosure in our standards? To me, that was an interesting observation that she had made, and I wonder how much of that is going on in our capital markets as well in terms of a lot of disclosure, and how much of that could perhaps be avoided if it wasn't material.
Well, your comment about taking these as communication vehicles to help investors allocate capital, make investment decisions, I think we've lost track of that versus the compliance side. But to change that, you're right. I think all the bodies need to be working in unison. And I'd even say as auditors, I mean, right now we're required to report, immaterial disclosures to audit committees. And they go, well, why is that? Why are we not compliant? Let's put it in. So all of us need to work together. Brian, as a regulator, any?
Well, no, I share Cameron's concern and the volume of what you have, what's relevant, what's not. I mean, I mentioned the audit, the expanded audit report. I think that's trying to get back to what is the relevance of what's in the financial statements. What were the key audit risks? So I think this is a challenge. I think, though, as we live in a communication age, if you like, an instant communication, I think you've got to not only look at the relevance of the 12-month statement, the annual report. What about the quarterlies? More and more investments are made on the quarterlies, and that's not required in all jurisdictions today. Auditors don't really spend a lot of time on that. They do a quick review. I think in terms of Cameron's thing, I think, we can fix some things in the financial statements. I think maybe a broader question is it the right information being communicated? And is it on a timely basis? That's probably a broader topic and more of a challenge, but I think somebody at some point has to really think about that very carefully.
Well, what I heard certainly amongst this panel is a consensus that something needs to be done. Sounds like some things are happening on the regulatory front. But I'm harping back to Jim's comments. This has been tried before and nothing's changed. So it really is what it's going to make a difference. And I think actually audit committees can be very helpful in driving that forward. Even when you think about your year-end disclosures, I think this year is a bit locked in, but think about it for future years. One other thing I wanted to touch on is the use of non-GAAP measures. And a lot of people say that the P&L has lost its relevance. It's become a dumping ground. It doesn't really show the performance. So of course they come up with their own performance indicators, and EBITDA and other things are used out there. The question is, how good are the standards? Like, as an investor, when I look at those, what is the credibility behind EBITDA and all the adjustments to it? And what should we, as audit committees and audit committee members, be doing? But first, maybe Cameron, what's happening on the regulatory front?
Well, non-GAAP measures has been a topic that's been kicking around for a while in the regulatory world. We have some expectations in Canada that the Canadian Securities Administrators has published in a notice, it's 52306, that talks about what to do when you're using those measures. Make sure you have a reconciliation. Make sure that you use a name that's meaningful for the non-GAAP measure. Make sure you don't provide it with any more prominence than the GAAP measure. So we have some guidelines, some boundaries. And internationally, we are almost final in coming up with a similar guideline that we published for comment for consultation, and now we're assessing those comments. So internationally, globally, we may be able to move the bar to get some consistency in practice. So you mentioned EBITDA. That's an interesting topic as well, because sometimes we see that in the financial statements as a subtotal, and we see all kinds of subtotals these days under IFRS. The standard setter has now come out with some amendments to IS1 to say that if you use those subtotals, make sure and do some of the things that I just said. Make sure that the label is meaningful. So if you use EBITDA, make sure it's earnings before interest, taxes, depreciation, and amortization, and not a bunch of other stuff, restructuring, pension, other things that are excluded from EBITDA. Make sure we use those words appropriately. Make sure we label the subtotal appropriately. And make sure it's used consistently from period to period. Let's give investors a fighting chance in assessing these non-GAAP measures. We're not saying don't use them. We understand that they are useful to investors in some way, but tell them why it's useful to them. Why does management need that measure? What do they use it for? And what should an investor use it for? That would be useful.
Just one last comment from panelists on it, and it's about what audit committees might be doing around those measures. Obviously, if it's in the financial statements, the auditors look at it and report on it, so you have some comfort. If it's in the MD&A, the auditors don't typically look at it. If it's in other disclosure documents, there's very limited look at it. So if that is a key performance indicators, what should audit committees be doing around that? Jim, your thoughts and reaction?
Well, I think there's a lot of these non-GAAP measures are very critical, and there's a lot of industry-specific measures. Retail same-store sales is a critical measure, drives the market, and yet there is no standards for the computation of same-store sales. In telecoms, it's ARPUs and utilization statistics in hotels, and every industry has some very key industry-related metrics. The audit committee needs to understand the basis, and they need to understand when there has been a shift in consistency in those, and perhaps maybe they should be engaging internal audit or external audit to be conducting a review of those critical measures, because these are very important metrics. Very important metrics for assessing performance, and somehow we got to sweep them in to make them not second-class citizens, but recognize their importance and give them appropriate level of assurance that they're done right.
So I think that's the second message here, obviously around reporting, what can you do on that front, but also to the extent you are using non-GAAP measures, they're key performance drivers, what comfort do you have around them, and what role should the audit committee play around that? It is time to put you to work now, and we do have a question. What are the key initiatives your boards could take to improve the quality of corporate reporting? Welcome back. We gave you a tough task in terms of trying to solve this issue of corporate reporting and improving it. In fact, along our theme is more or less. So hopefully some very good discussions and some good ideas. Back to Jim's comment, this has been raised years back, and the key now is how do we make a difference collectively around this. Another thing you would have seen on your tables is this. We're moving into the next century, and last time I talked about blogs. This time we're now going to get on Twitter. And so if you do have your Twitter account and you want to prepare some comments on the role of audit committee, you just hit hashtag Director Series and put your comments out there. Patricia, we were talking about risks, and I talked about some of those clouds on the horizon. You spent a lot of time, I know, on the strategy side and the risk side at National Bank. Your thoughts on things that boards and audit committees should be thinking about?
Thanks, Don. So I thought I'd touch base today on 4 types of business risks that are not necessarily food for thought, but I think are realities that are facing us. So I'll touch base on 4 of them. One of them is, I think, cyber security disclosure. We've seen, as just a matter of fact, in the last 2 weeks, the fact what Sony has gone through. I think companies have stepped up efforts with regards to address cyber security in recent years, but the increasing speed and the growing sophistication of those attacks is really raising the question of how well is management and boards able to keep up? While within corporate America there's a growing realization that large consumer data and intellectual properties are up for grab, the question here is, are they correctly protected? Nearly, I think, every organization is vulnerable. We've seen attacks, not necessarily from large U.S. companies, but we've had, government entities, we've had universities, obviously being attacked on those issues. And for directors, when you touch and you look at cybersecurity, this has been a recent shift to really high alert. When you look at the never-ending series of breaches that have occurred across, the 10 countries, but a lot of them in the U.S., there's a very concerned that this is a really high impact with regards to growth going forward. As per a PwC, they've been able to manage and survey directors, and 59% saying this is going to be a serious threat to growth in the coming years. So when you look at the cost of breach, we've noticed that these are on the rise. The average cost right now is roughly $3.5 million, and this is up 15% on a year-over-year basis, and that's as per a survey touching 10 countries. When you look at the precise numbers for the U.S., that 3.5 grows up to 5.9 million. So there is really some direct and indirect costs. When you look at the cost of breach of the information per data, per customer file, this has also grown by 9% year over year to $145 per customer file. So you can see that this is a big number going forward. And when you look at the cost of breach, the direct expense, I think, when you're in a defensive mode, you're obviously facing those costs, and these can go from obviously engaging forensic experts, putting hotline support in, providing discount subscription to customers that have been touched. But there's also indirect costs with regards to, in-house investigation, communication, customers that you've lost. I guess one of the other elements is a lot of companies are on the defensive mode, but I think one needs to consider that you need to be a little more proactive, and that means to be able to prepare and invest money in terms of, additional compliance with regards to the different industry and the industry class that you're touching, because each regulator have their own rules, so then you're just adding up the costs. I guess there's a lot of things that could be done. I'm just going to touch base on a couple of them. Is One of them is, looking at our internal data, but one has to look at outside because we're dealing more and more with third party, and a lot of those breaches are coming in from those third party that we've engaged to manage our operations. On a board perspective, to be proactive, you need to provide or to be provided with, additional detailed briefings. You have to have good processes from the start and not necessarily, again, being on a proactive basis. And you have to have a response plan and not being able to just being on a damage control basis. You have to make sure that you do have, and you're able to recruit tax expertise. More and more, all the companies are looking for the same expertise, so these are becoming scarce and very expensive. And the other thing I'd say for a board is trying to know what's your risk appetite, because obviously this is not going away, this is here to stay. So one of the questions that boards should probably ask themselves is, on an enterprise-wide scale, is security being treated on a corporate risk register? Are we, companies and boards, looking at cybersecurity on the annual report basis? Are we asking questions in terms of if expenses were incurred, are they reporting it? Also, what's the impact of the brand? This is a very difficult number. It's really intangible in terms of putting a value to it. So I'll let you, obviously think about that. I'd like to move maybe to a second type of risk, which is the growth levels in Canada. We're facing right now a very low inflation environment. When you look at the Government of Canada projection, they're looking at 2%. People would say, when you're speaking with top economists, they're probably saying, we're probably going to target 1.5. This jive with the U.S., which should be at 1.5. Japan should be at 0.8. Even Europe will only be at 0.5%. So basically, management and boards are facing, or they need to adapt to this new reality. The double-digit growth is somewhat of the past. And even though, this has been around for probably the last 18 to 24 months, it's something that's probably going to have to linger on for the next couple of years. And the natural reaction for management is to move into a cost containment exercise, which is trying to cut expenses to be able to have a positive operating leverage. However, companies have to face the fact that the economic cycle is faced with what I call structural factors versus cyclical forces. And in the past, those cyclical forces were probably, 60% of what companies were facing, and now we're probably diminishing that to 40, with structural being at more of a 60%. So what does that mean? One of them is demographics. We've been talking about it, that there's an aging population. There's been numbers that have just came out that for this year, for the first time, the age group of the 20 to 40 years old, it will be on a diminishing basis, which is something that we've never seen in the past. So obviously that impacts companies, consumer products, financial institution, which this age category are mostly on the credit mode versus investment mode. So it changes the whole dynamics of how to address your top line growth, how to address this population. But I think companies need to focus on other elements, which is when you're in that kind of structural environment, is you have to move in and make sure that you protect your market share, or at least try and increase it. You have to look at innovation. That is something that we constantly think about it, but very few of us are really good at it. Looking at acquisitions. Companies in Canada are fairly conservative. Since the 08-09 period, they've been hoarding cash. So we need to be able to look at it and be able to push potential acquisitions. The other thing is Canadian companies need to look at globalization beyond what they currently do with regards to the export process. I guess one of the other elements that companies have been doing or facing is the market and the conundrum of either investing in good projects or returning returns to shareholders. And this is something that, we need to be able to push management with ambitious projects to be able to invest in companies and promote top-line growth. And this, when you take into consideration the 08-09, I think in Canada we built a culture of bias against risk. I think whether it's the top line or either middle management, we have become somewhat risk averse with regards to making routine investment decisions. We're comfortable in terms of, having a deleveraged balance sheet, hoarding cash. So the issue here is, have we shifted the company's risk profile in terms of having low risk environment and high liquidity just in case of? So that's one of the elements with regards to facing very low growth levels in the years to come. The third topic I'd like to touch base is the interest rate in uncertainty. Lesson learned again from the 08-09 is the fact that never to project liquidity conditions. I think we've come with the safeguard is, that liquidity here is here to stay. This is something of the past. However, the reality is, the global economy is less synchronized when you look at what's happening in Europe, Japan, the US. Monetary policy is less predictable. Projecting liquidity is even very difficult, even in this current environment. So how do you manage liquidity risk? I think in Canada, we tend to be on the cruise control. When you're a CFO, you look at what Bank of Canada is projecting in terms of what's the interest rates going forward. We just apply that in our financial statements. However, we forget the lessons, that we should keep in our mind is, lessons learned is don't put your eggs in the same basket with regards to financing. Just diversify your sources of funding. The other element is, in this low interest rate environment, try and be able to lock in terms of some of your financing, diversifying it, if it makes sense, obviously, commercially. And do not neglect putting feet in not just the banking, the financing environment, but also the market financing. This helps with regards to if the market shifts. I guess the other underestimation is the additional regulatory body, the shifting of regulators that have been much more tighter. Just to give you two examples, we've seen, Bank of Canada really tightening on rules with regards to mortgage financing. Now they're looking at more closely the auto loans financing, those long terms, 8-year financing new cars with the resale value. Nobody has seen whether this will weather the storm going forward. We're seeing much more scrutiny in terms of, the type of financing we're providing to corporations. So, one needs to figure out and being cautious in terms of being able to have more flexibility. So that's one of the elements. I'd like to maybe just finish off on another impact that we're seeing in the last year, but basically more importantly in the last 15 days, which is the oil price decrease. Since the end of 2004, we've seen the biggest decline since the financial crisis. Just in the past 2 weeks, the price of the commodity has dropped somewhat, quite below $50. I think Don, touched base on the reasons, but, this 46% drop in the North American oil prices since the end of 2013 has already, forced, really deep spending cuts in just the Canadian oil patch. So globally, lower oil prices is good for the world economy, so there's winners and losers. But, the fact that this brings lower inflation, increased consumer real spending, there's higher growth prospect in non-oil emerging economies. The real winners are obviously some provincials like Quebec and Ontario that will benefit, but there's other provinces that will be impacting negatively. The GDP growth, which was projected at being 3%, will be shaved by probably 30 basis points. So when you look at the fact that energy-intensive producers will be benefit to manufacturers, consumers should end up with probably $12 billion of additional power of spending if oil prices stay low for a while. And exports to the U.S. will be able to, obviously increase dramatically. Again, if oil prices at the pump stay low, there should be an increased spending for non-energy firms, provided they can see a line of sight that this is going to stay forever, or not forever, but for a longer period, and they can really put money and invest in different projects. I guess the question I'd like to put forward is the magnitude of and the speed of the drop in oil prices has, taken most analysts by surprise. The question here is, are the companies really equipped to really analyze their impact? Yes, from, I think, a short-term direct impact, they look at revising their budget, looking at their expenses with regards to fuel and this and that. But the indirect consequences is really trying to drill down in terms of their customers, how impacted. Is that going to impact their top-line growth, their suppliers? So all of these means is being able to shift quickly to be able to adjust to all of these different business risks that are impacting the business per se, with outside elements that are probably not in your radar screen and not probably in your risk factors that you've implemented a couple of years back, that you review on a constant basis. But these are really not necessarily big black swans, but necessarily elements that could impact from a material point of view. So I guess my key takeaways would be, never neglect the fact that the outside factors are there, and the structural changes, we need to take that into consideration and can bring on some surprises that we need to adjust quickly.
So as you listen, no doubt all those issues be important for the board, and we'll hear shortly why they're also very important for the audit committee when you get into year-end estimates and whatnot. I think it'd be quite interesting to take a look at the risk registers. My guess many of these would be on them. The question in the scenario analysis, did they take oil down to 50 or down to 30? Did they go that far, and are they ready to respond to that? Similarly, what's the impact on foreign exchange? The big move, how does that impact your business? So question of how good that scenario planning is. One thing that I want to get a reaction from the committee on is around cyber risk. And you mentioned about, the risk appetite, being resilient, and those sort of good things. But this is obviously a key thing, and all audit committees I've been involved in, there's been lots of discussion around it. But the question I have for the folks on the audit committees is are boards and audit committees, are they getting ahead of this enough? I mean, the bad guys are very smart. They keep moving. So is all the work that's done by management, by the audit committee oversight, and the investment, is it there, or do we have a lot further to go? Maybe, Patricia, I'll let you start and then get Jim your reaction.
Well, we've seen a lot of larger U.S. companies being impacted. So I think the feeling for a lot of companies is that, this is to attract either retail-oriented companies or the big, top S&P 500 entities. However, these hackers are really attacking, like I mentioned, government entities, universities, just to get, a handle on the information. So basically, I think a lot of companies are looking at it, but from a probably proactive basis, just in case. They're not necessarily being proactive, saying, I'm going to invest to make sure that the big data that I have invested in is well protected, to make sure that, they're able to analyze what is the reputational risk attached to if my company is really attacked. What are the, how will consumers will react to the fact that, the data information has come out, the leakage and this and that, customers are upset about it. So there's a lot of costs of damage control that needs to be attached to that. And I think a lot of companies, it's a really small sectors of the businesses, the IT sometimes, that are attached to that segment. And there's not much information or money that has been invested because we've cut down the budgets in the past couple of years. So I think the last two elements, the target and the last one, I think should open up the eyes of companies and say, wow, it's not just picking up on some, customer information, but it's really hacking and having major impacts.
Jim, any?
I think this is a sea change. This is just a total change in looking at risk. To echo some what Patricia says, everybody's vulnerable. If you look at the past, charities, government agencies, CRA got hacked and we had to shut down last year. The Ottawa Police Department got hacked. You've got J.P. Morgan major, and the Sony attack is particularly significant. And you think of the damage to the brand. You think of the damage to the Target and the Sony, and the damage to the brand that occurs with that. And remember, Sony got their PlayStation network got hacked before that. So, and you just can't assume. I mean, there's a variety of hackers. So you've got who are the key players here? Who are the perpetrators? You've got the hacktivists who are interested in embarrassing people. You've got people who are interested, like in Sony case, of actually damaging the company. You've got people stealing credit cards for commercial. This is organized crime. You've got state-sponsored agents in terms of involved here who have phenomenal resources backing this activity. So everybody's exposed, and I think we're all playing catch-up. I think the financial institutions and the retailers are probably on the front line. But everybody's exposed, be it the Ontario Securities Commission, to government agencies, to everybody, and we're all trying to figure it out. And it's not just a technology problem. It's as much a people problem. If you look at the way that a lot of this malware gets in, is people opening emails and people not changing passwords. So it's how do you change the total culture of your organization so that we're operating in a new world. So there's people issues, technology issues. We just got to start looking at things differently.
So there's another call to action in terms of your agenda going forward, but certainly having that there, it's broader than just the retail industry, financial institution industry, and it's often an internal problem because that's where many of the big issues start. Let's shift gears because we do need to think about those year-end reporting activities. We'll be picking up the theme of structural change in terms of the accounting implications and estimates. But Jim, over to you.
Okay, thank you, Don. I thought I would focus on three things. Take a look at disclosure risks, some of the issues we've been talking about. The second is, as you go through your year-end meetings, the importance of ensuring you have a robust CEO and CFO certification process in addition to the audit quality issues that Brian talked about. And then, Don, come to the issue of accounting estimates, which I think is going to be it's critical every year, and I think it presents a unique challenge this year. So those are my three things. At the right-hand side of the chart in front of you is a shameless plug for a new CPA Canada publication on CFO certification, which was written by Alan Willis and myself. We put out a publication and we put out a guidance for audit committees and management in 2006, and the CPA Canada asked us to update this. We first said, well, what's the importance? So we said, okay, we'll do that. As we got into it, we became far concerned. In 2006, we believed it was an important process. We now believe even more that it's an important process, and we think there are some levels of concern about how robust this process is now. So we'll talk about that. And in your handout material, I'll also say there's some additional slides that Don said I wasn't allowed to present on the screen, so I'll refer to them. Okay, let's talk first of all, and switch to disclosure. In our CPA Canada publication, Alan and I developed this sort of analysis of disclosure, and we tried to look at it, said, what are the layers of disclosure? And at the center, in the shaded box circle, you'll see that's the quarterly and annual financial statements. Okay, so that the next one out is the other required disclosures. So, Cameron, that would include the MD&A, the AIF, the proxy circular, timely disclosure releases, other things that are required. Third layer out is the voluntary reports and information that companies provide, health and safety reports, environmental reports, social responsibility reports, all of those kind of things. And then in the outside layer, Don, is the world of Twitter, social media, blogs, chat rooms, and all of that kind of thing that's going on. So, given that profile, the question that boards and audit committees need to say is, what information in that disclosure universe moves the market? What is the information that moves the market with respect to your company? And that ties back, maybe, Don, to your question about, non-GAAP measures, or where is that information? And then the second is, do we have the control structure matched up against the disclosure universe and the key information that moves the market? If the right-hand side of the chart, you can see two levels of control. One is controls over ICFR, which is internal control over financial reporting. That's the controls over the information in the financial statements. The second level out is disclosure controls. Those are the controls over the information that's required to be disclosed. But you can see then it stops. So what is the controls over the information as you move farther out into the disclosure universe? Well, it's primarily your disclosure policy and the processes and procedures that your company has put in place in order to implement that disclosure policy. Now, underneath all of that is the data. Okay, there's data that flows up and is communicated out. There's data that's kept internally. And as Patricia has said, that's where the hacktivists are often now attacking, is to get at the data. So the next level out, Don, is the disclosure that's made by somebody else that you don't make. And if you look at the Sony hack, well, that included a whole bunch of disclosures, or the WikiLeaks stuff. That's all information that's being data that somebody unauthorized to your company has got a hold of and is communicating to the outside world. So what's the control over the data? And as Patricia has indicated, companies are investing a lot of money into big data, into trying to take data and data analytics and turn it into a competitive advantage. So that then exposes, that then is a key exposure. So what is the data governance that is needed to oversee that data, the management and the strategic use of data and the control of data is appropriate? So one of the things, Don, I think, is that we need to rethink our whole control structure now. We can't just pigeonhole things into nice little packages like ICFR, DCNP. Everything's coming together because the electronic data is everywhere in a company. And so we need to think about that, start thinking about that differently and more holistically. Let me talk just a little bit about two other types of risks, Patricia, that you did cover. One is liability risk kind of thing, because in the disclosure with year-end audit committees, we'll be thinking about the issue of, well, what is the accuracy and reliability of the information that we're approving and putting out, and what are the risks associated with that. Now, of course, in Canada, civil liability came into effect, Cameron, 2005-ish, somewhere around that started. Well, if you go to a company, Nera Economic Consulting, and this is a slide that's in your handout, put out some information that said since 2005, there's been 52 civil liability cases filed. 17 cases have been settled for approximately $280 million. And 31 cases remain unresolved, which the total of the amounts claimed amount to $16 billion. So civil liability is having an impact. It is a risk, and the civil liability risks are real. Now, what's the best defense against civil liability? Well, if it relates to the shaded box at the bottom, the annual financial statements, we directors have a number of defenses. One is we have the external auditor's report on the annual statements. We have the review report on the quarters, and we have the certification by management on internal controller for financial reporting. But ask yourself the question, what's the information that moves the market? Does the annual financial statements move the market? Well, I think they're a very important accountability report, but as Brian observed, maybe it's the quarterly earnings have a much bigger impact on market performance and move the market than the annual reported earnings. And maybe we have the controls not really matched up against the information that really moves the market. So that's a question there. Now, the next thing is when you move to the MD&A, which is in the second circle out, what's the control over the information that's in the MD&A? Well, there's the people that prepare the information, but what's the control over the information that's in the MD&A? Well, it's largely disclosure, control, and procedures. And the control is that management certifies that. So there is some. But how effective is that? How effective is the certification of the control, disclosure, control, and procedures? Well, in that case, Cameron, I did go back and check on a CSA release. It's Staff Notice 52327. And it presented a review. It was done in 2009 and 2010, surveyed 195 companies. And in 2010, they found that only 45% of the companies, this is 45% of the 195, got a AAA rating, i.e., there was no changes required. So for 55% of the companies, they had to either change things prospectively or go back and refile or do things. Now, the CSA only looked at the disclosure. They didn't look at the process behind them. But if the disclosure is wrong, for example, companies who said that in their certificate that they presented their results of their evaluation of internal control in the MD&A, and when the CSA went and looked at the MD&A, there wasn't anything there, that would suggest to me that the processes supporting the certification weren't really highly reliable too. So the good news out of this is that the civil liability legislation gives us a defense. It says that you can rely on a reasonable investigation and a process. Okay? The problem is we have to be duly diligent to ensure the defense is available. So audit committees, I would say, is make sure that this year-end audit committee meeting that you ask questions about the evaluation of controls and the rigor to which your CEO and CFO have approached the certification process, so that that defense will be available if and when you need it. In your handout material, and I think, let me just say a couple of things about the MD&A. And it reflects on some things Patricia said, and Don and other members of the panel. The MD&A, I think, is a critical document. It's even more so this year. At your analyst call, management is going to be first, I'm sure one of the first few questions they're going to be asking the questions Patricia said. What has been the impact of plunging oil prices? What is the impact of the low dollar on your fourth quarter results? And management's going to have to. So make sure you have that answer in your MD&A so that there's not different pieces of information that's coming out at different points in time. So that'll be a critical piece for this year, is looking at what of all of the things that Patricia's talked about, all these things that are going on right now that investors and analysts will be very concerned about. Make sure that they're expressed in your MD&A. Make sure that your non-GAAP measures in your MD&A meet the criteria that Cameron has talked about. And look at what's the level of, because the other thing that investors will be interested in is what's the go-forward impact? In other words, what's the risk assessment of, that oil doesn't recover quickly? How does that impact you and your business? So MD&A, very critical for this year, and anticipate the questions that are going to come from your analysts and make sure you're proactive in dealing with them in the MD&A. Final piece is, as kind of leave that disclosure universe thing, is impact on the audit committee. The audit committee is already an overworked committee of the board. And when we start talking about cyber risk and disclosure risk and all of this kind of thing, then how is if you're delegating that to the audit committee, how are they going to handle that? Okay, I'm getting the signal from Don. I better move this quickly. So in the next two charts are 7 questions. I'm not going to go over those in detail. In fact, I'm not going to discuss most of them at all. The only reference to 2. First one is question 4. When you're looking at the certification process, ask your auditors as to what their view of the certification process. They should have a good information for you on how rigorous it is, how involved was the CEO. Did the CEO and CFO provide the proper tone at the top? So on and so forth. Was the sub-certification process effective? That's an important piece of information for you. The next slide, question 5, very critical when you look at the issues of how rigorous did the CEO and CFO conduct the assessment of the operating effectiveness of both disclosure controls and internal control, particularly disclosure controls, because we've got lots of work going on the annual financial statements, but that next level out, particularly the MD&A and the proxy material, and that kind, what's the quality of disclosure control over those? So that's that. Let me conclude, Don, with a couple of thoughts on accounting estimates, and I'm going to pick on three things that have been said. First of all, Patricia made a very important point, I think, about are the things like the plunging oil price and the dropping loonie, is this a cyclical issue or is it a structural issue? And that has a big impact on how we deal with accounting estimates. Accounting estimates in the financials, we have, as Cameron has pointed out, the amount of accounting estimates is growing. We have more and more fair value information. They're all estimates. And along with the traditional estimates like doubtful accounts and inventory and that kind of stuff. All of that's growing. So how do we cope with that? Couple of thoughts. One is you should make sure that you get, as an audit committee, an inventory of all of the estimates. Be able to then, and you have sufficient information from management that allows you to be able to understand how did they approach this, what methodology did they use, what are the key assumptions that they make. Back to Patricia, did they said that, oh, this is just a seasonal issue, or is it a structural issue? What's the sensitivity? What's the impact on earnings? We could be at a very key point in time in terms of where the economy goes. And so how are these estimates, what's the basis on what they're prepared? So on the slide are questions you might ask for management, methodologies, sensitivity of impact. What's the degree of optimism or conservatism that's built into those estimates? And finally, again, a question for your auditors. What did your auditors, how did they approach the audit of estimates? Did they apply the professional skepticism that Brian talked about? And for a little plug for Brian's 2014 report, there's some good questions in that report, which is on a slide for you, on the questions that you should ask of the auditors in terms of how did they approach the audit of accounting estimates. And finally, Don, I think that this year, to pick up on Patricia's comment about managing liquidity risk, and also her comment, which actually scared me to death, which was that most companies aren't really equipped to handle the assessment of the impacts of things that are going on. Isn't this now a appropriate time to not just look at the estimates, but then put them in together and to actually stress test those estimates, play out different scenarios? What if plunging oil prices and a low dollar is not cyclical, it's actually a structural change? How does your balance sheet stack up? How does your liquidity stack up? So to take the stand back and do a bit of stress test. We've got a lot of small cap companies in Canada heavily dependent on the resource sector, for example. This is going to play into going concern issues, liquidity. So I think stress testing the balance sheet at this point in time, Don, is something an audit committee should do.
So, Jim, I've got lots of questions, but I think we're going to get our audience engaged. There was actually a number of very important messages there. Certainly the run around accounting estimates, how important it is. And it should be the standard hockey stick, maybe because of the structural changes and lower growth rates, single-digit growth. Maybe we need to look more closely at those changes in looking at accounting estimates. And Jim, I also heard the certification process, well, it's a great friend. It looks like it could be, tightened up and more energy on it. But really struck me was, what about all the other non-financial information? How good is that disclosure policy around that, and who's watching that? And then clearly the message on data governance, which everyone is dealing with. But with that, let's go out to you. And here's the question. What will it take to get a more rigorous oversight of internal controls or broadly controls processes into the or onto the audit committee's radar screens? Talk about that at your tables.
There's two questions on mining.
Where's that one? Oh, yeah, okay. Welcome back. We've got a number of questions. We thought we'd handle the Saskatoon first because we understand how cold it is out west. And Brian, I'm going to send this over to you. Can internal audit play a role in assessing external audit performance, bringing value, auditing our risks, etc., including the external audit plan?
I think the answer is absolutely. Internal audit at a number of organizations is well established. Very competent folks are in those roles. They can clearly play a role. They understand audit. They understand how the process should work. Most of them have probably come out of audit recently. So I absolutely would encourage this. And really, when you get into this in terms of your annual assessment or your mandatory comprehensive review every 5 years, I think internal audit can play a key role in working through those types of reviews.
Jim, well, it's cold here in Toronto too. So, Jim, do you think EBITDA should be a mandatory disclosure in a separate statement or in the notes to financial statements, especially for companies that require or rely on public debt or bank debt?
My answer is an emphatic no, and let me explain the reason. EBITDA can be useful, but it can also be misunderstood, and it's often used as a proxy for cash flow. But we have a statement for cash flow. And so the problems with EBITDA is that it ignores investment in working capital and that whole dimension. So you can generate a positive EBITDA with absolutely no cash flow. And so therefore, I think that the real issue here, though, is understanding not only profitability, as Cameron has pointed out, and Don, I think you pointed out, in terms of the impact on the profit statement, but understanding cash flow, and particularly understanding free cash flow. I think free cash flow is a critically important measure in terms of looking at operating cash, less dividends and less CapEx expenditures. And so understanding free cash flow and understanding operating cash flow, I think, Don, is really important. I worry about an over-reliance on EBITDA because of its simplicity and not getting behind the dynamics. And if you don't relate EBITDA to enterprise value, which was its origins kind of thing, then I think it could be misleading.
Okay, here's a question from Montreal on IFRS. What is the status of IFRS adoption by the U.S., and doesn't the fact that U.S. GAAP still prevails diminish the significance of IFRS?
So really what this question is getting at is where is the SEC on IFRS adoption? Let me just be very clear that the SEC in the U.S. are very engaged in IFRS. They have 500 companies as of now that are filing IFRS statements. We, Canadians, are the largest supplier of IFRS financial filings to them. So they are engaged. They have to be engaged in the topic because of the amount. Now, for domestic issuers, that's really the question that they're getting at. Could domestic issuers make use of IFRS, or when would that be mandatory? Well, the latest thing that's being kicked around down there is, could there be some sort of optionality, a secondary amount of disclosure in addition to the U.S. GAAP? Could there be an optional filing with some IFRS information? Would that be a good next step? So that's something that they've said publicly that they're thinking about as a possibility. There's a lot of criticism about the fact that they're not moving fast enough. I'm more of a glass half full kind of guy, I guess. I look at the fact that the ISB and international standard setting has been in existence for 10 years. That's not that significant or that long of amount of time if you think about the length of time our global economy has been functioning. And a lot of progress has been made in 10 years in terms of converging these two sets of standards. So I would say, look, let's not come to a conclusion on a single set not being in effect right now. I want to see where this is at in 20 years from now, 25 years from now. I think we'll be in a much stronger position. But until then, it's important that convergence continues to happen because in Canada, we have two major sets of accounting standards in our capital markets.
So stay tuned. Here is Winnipeg. Patricia, I'm going to send this to you, a governance question. With the ongoing responsibility and lots of work of audit committees, should boards consider establishing a risk or an IT committee?
From a personal point of view, obviously we know in the market that banks and now insurance company do have, strong audit and risk committee. I guess what you see in the market, there's more and more risk involved that are, attracting more attention. And I think even for smaller entities, it would be worthwhile just to start with a small group that is identified as a risk group. And depending with the size of the company as it grows, whether they should be a separate entity or should they, report into the audit. I think it depends on the size and the scope going forward. But I think for a medium size, I think it's worthwhile to start looking at a risk committee. With regards to the IT committee, I don't think there's a need to have a separate board IT committee because the scope of looking at IT is so huge. But I think there should be a definite segment of the discussion at the board with regards to looking at the major projects, delivering on time, on budget, and what are the impacts on the strategy of the companies as a whole. Because more and more is strategy. You need to define not just your business strategy, but how you're going to implement, and that take care of IT implementation type of projects.
Now, this is the fast close drill. I'm going to go around to each of you one key takeaway that you would give to audit committees for year end. And I'm going to start with you, Jim. One key message for the audit committee.
I think it's the accounting estimates, which includes impairment assessments, fair value assessments, that piece, and how do you deal with the impact of the highly uncertain environment in which we live.
Okay, Cameron?
Disclosures, I would say focus on those material items and provide good insights as to why those items are in the financial statements, provide insights from management's perspective, not just information but insights. And I think if we do more of that, we will develop the financial statements into more of a communications document for investors and not as much of a compliance exercise.
Patricia?
I'd say look at the risk registry that the management is bringing to you, and don't be shy to look at the external events that is touching different entities and try and make sure that these questions are being asked by management and not just stick to a cookie cutter risk registry that has been done in the past and they continue to prevail.
Brian?
You've got an opportunity to have a robust discussion with the auditors, management, and the audit committee around audit quality. We've provided some insights and greater transparency of CPAB findings. I would just encourage you to take that public report. There's a list of questions in there to ask your auditor. The more robust the discussion around audit quality is as you sign off on these financial statements, challenge your auditors, challenge your management, I think it'll make for an enhanced package around your audit and your financial statements. I would encourage you to have a robust discussion.
Well, thank you, panel. I guess I get the last few words in. And Cameron, I'm going to pick up yours. I think the idea of communication rather than compliance, you still need to comply, but think about that in terms of providing useful information to the decision makers. In your handout, we have another publication, Is More Less? And so clearly the theme, we believe less is more. So let's get focused on that. A challenge for you as you go through your audit committees. Once again, I think it's a little late in the cycle, but next year I think you can be thinking about it. How can you actually trim down your disclosures to make them more meaningful? A couple other things. We have something called the Director's Alert. There's a card in your package. It's got the top 10 issues for 2015 that boards need to be thinking about, including things like cyber risk and managing your reputational risk. Do have a look at that. You can access a soft copy online. Social media, I talked about Twitter. We started a blog last session. Our opportunity to expand and extend the dialogue with board members. We started on emerging risk. We had a lot of traffic and good communication. We're going to continue it. There'll be some people engaged to respond to the questions you have. There were a number of questions we couldn't get to today, so we will go to use that site to respond to those questions. So do visit us at that address and that blog. And with that, I do wish you all a very happy new year. Good luck despite those clouds in 2015, and hopefully you found our session today of value. Take care.